All right, welcome everyone to another one of Option Hotline's free trading webinars. We are here this afternoon with Keith Harwood, Chief Option Strategist at Option Hotline, and Guy Adami, CNBC Fast Money Panelist. We are so happy to have both of you here today, and we are excited to have you talk about the post-2020 election market breakdown. There's obviously a lot to discuss on this topic, and it's been quite the flurry for the past few weeks. So we are excited to have you and ready to get going. I do want to give a little brief intro to each of you, though. Guy began his career back on Wall Street in 1986, and he is very well known for being a panelist on CNBC Fast Money. He was actually approached by CNBC in 2005 to star on this show about Wall Street traders, and he is the sole remaining original member to still be on this show. So that's quite the accolade, and we are pumped to have him here. Thank you, Guy.
Thanks, Nat.
And we've got Keith Harwood here as well. He's the Chief Option Strategist at Option Hotline. Keith started his career back in the options pits of the CBOE, and after working in the CBOE for some years, he decided to transfer over and start educating retail traders exclusively since 2017. And he is the author of several different trading programs and newsletters here on Option Hotline. And we're happy to have him here as well. Welcome, Keith.
Thanks, Natalie. Thanks, Guy.
All right. Well, I'm going to let you two fellows go ahead and start on this somewhat excruciating topic. So feel free to go ahead and jump in. And one last reminder for all the attendees, if you have questions, type them in the Q&A or the chat box, and we'll get those over to Keith and Guy. Thanks,
Thank you, Natalie, and thanks, folks, for spending your time with us. Appreciate you taking time out of your busy days to be here. Obviously, thanks, Keith, for being here as well. It seems like it was just a couple of weeks ago we were together, but it was a few months ago when we were talking about the setup into the election, Keith, and now here we are, a week or so past. Obviously, the market's been the story in so many different ways, and I want your thoughts on what's been going on, but what we've seen, and we'll see if it lasts. There's some signs today that maybe it's not going to last as long as we think. But in terms of rotation, we saw a tremendous rotation out of these growth names into some of the value names. We saw the S&P 500 make a new all-time high. The prior week, things looked to be extraordinarily under pressure. And we're going to talk about the volatility index, but the VIX, which was trading for 25 seemingly for weeks on end, spiked up to over 40. Tested the levels we saw back, I think, on June 5th or so. The market troughed, and the VIX sold off in a meaningful way, so much so that you have a VIX probably lower than it was 3 weeks ago. So a lot to talk about here, Keith. But when you look at it, what do you glean from all this, the last couple of weeks' price action?
Yeah, I think so for me, going into the election, I think was probably just a sign that everybody wasn't quite sure what to do, since we basically had, maybe the numbers said that Biden was a 70% chance of winning or an 80% chance of winning. I think a lot of people basically thought of it as pretty close to a coin flip anyway, much more so than 4 years ago. Everybody just kind of wanted to go to the sidelines, and then as soon as they knew the result, they wanted to go put all their money at work. And we just had a weird situation this week where we basically had, sort of official result. We've still got some legal stuff going on, but it sounds like Biden's going to get the next 4 years. And then, of course, before we can even open the markets on Monday, we get the announcement that Pfizer's got a 90% successful vaccine. So, we're, basically changing the entire election thing, taking that off the table, and maybe seeing a path at the end of the tunnel on COVID at the same time completely changes the way everybody wants to invest. That, I think, really drove a lot of that rotation. Maybe it can be a long-term story, short-term. Maybe it's a little overdone. I mean, the magnitude of that move Monday, Tuesday was huge. We're getting a fade of it today. Q's up a couple percent, small caps flat. For me, honestly, the biggest concern I've got on that rotation is when I see Pfizer. Pfizer's not up that much after everything that they've announced. I mean, where they were 2 weeks ago is basically where they're at today. If they've really defeated this, this terrible COVID situation, I would have thought the move on Monday wouldn't have been faded nearly as much.
It's interesting, right? I made the point on Fast Money last night that Pfizer, which at the last night, I think after the close was trading at 39. I said, basically, that's where we topped that up back in July. And We obviously spiked over 42, I think, at one point on Monday, and now you can see the stock where it's trading today. It's fascinating, though, that so many of these companies have come out with positive news or seemingly positive news, starting with Gilead, Moderna. It wound up being, the headlines wound up being the top for all those stocks. And quite frankly, that's what it looks like in terms of Pfizer as well. And then my question to you is, and I'm not looking to play stock market here, and I'd love to hear some of the programs you have and some of the things going on at Options Hotline and some of the strategies, but a lot of times markets top out on a crescendo of good news. And forget about the politics side of it. You mentioned the vaccine. Could we come back in 3 months when we're doing this and be talking about how in mid-November on the Pfizer news, that's when we saw the top of the S&P 500?
So I guess I'm torn on this. I mean, for me, when I think about what this Pfizer news means is it should lead to some sort of economic growth. At the same point, maybe it also leads to a reduction in future expectations of stimulus and things coming from the government. So if the earnings are there, we don't need the stimulus. If the earnings aren't there, we need the stimulus. We make up for it in other ways. The market tends to want to go higher because we're helping make sure it goes higher, frankly. Right. Maybe this is the good news that we needed in terms of getting people back to work, getting them what everybody needs, getting out of the house, getting back to the office, getting back to whatever. Or maybe this literally just is a precursor to something that can't really have an impact for 9 months or a year. I've heard, people saying that the vaccine really is going to take a long time to have an impact on the world anyway. So this means almost nothing in the short term. But now we see that light at the end of the tunnel.
Right. In terms of the rotation, no, I'm sorry, but I was saying in terms of the rotation, we've seen some head fakes, some pretty meaningful head fakes over the last 6 months or so. It looks like now's the time where growth is going to give way to value. And every single time it was exactly that, a head fake. And look, today is suggestive of exactly that. Maybe it was a head fake. What are your thoughts in terms, is the growth trade over, late innings, or is this thing still full speed ahead?
Yeah. So for me, I'd say I kind of think that this rotation has been destined to occur at some point. Maybe we finally got the straw that broke the camel's back to make that rotation occur. I mean, when you look back, I was actually looking at this yesterday, 5 years ago, IWM, that small cap ETF, was trading about $115. Today it's trading 172.5, 173. Yeah. The Qs were trading roughly the same price, around 115, 118, something in that range 5 years ago. Today trading 290. So the Qs have had a much better performance over the last 5 years for a number of reasons. Part of it's the fact that basically the top 5 names in the Qs are half of the ETF itself. But, you got to find at times that some of these other types of companies can get that money flow and can actually perform. I mean, it's a crowded trade right now in tech. That's part of what happened Monday and Tuesday. I think it's also part of the reason that we didn't have the follow through today on day 3 of that rotation. A little bit of profit taking for those that maybe did it. Maybe this is the beginning of it. I kind of want to lean towards saying, yeah, it's the beginning of it. But what I'm going to do is I'm going to use the technicals, which is what we do in my trading programs, is to say, let's watch the technicals. Let's watch how the stocks perform relative to their moving averages. Watch that money flow, not over 1 or 2 or 3 days, but over 10 days, over 2 months, over 6 months. See how everything looks as it's going. Try to get early on the new trends, and then just ride them with options to get that leverage. And I think that's what we're really keyed in on for the next couple of weeks, is finding the early signs of those new trends.
So anything, I'm not looking to play stock market here, but are there any strategies that you've been implementing or you're looking to put on that you can share with our viewers here?
Yeah. So right before the election, I was looking at putting a little bit of money into the market, just buying some in the money options. Because I think that one of the things you keyed on earlier was that the VIX is likely to fall coming into the election. When an unknown becomes known, uncertainty drops. And that's what the VIX is. It's the uncertainty index. So if we're going to drop implied volatility and potentially have a rally out of it, which is was my thesis, then I don't want to be playing with out of the money options or anything like that. I want to, if let's say, for example, the Qs, if they were trading at 280, I want to be buying calls around the 240 strike a couple of months out. Give me some safety, more like a stock replacement strategy. And I think right now stock replacement strategies do work in a lot of senses, because if we're right and if the trends continue, stock replacement gives me leverage. And if I'm wrong and these trends are gonna hurt me, well, being long a call gives me defined risk differently from being long a stock. So defined risk, stock replacement strategies, I think really can work right now. I do personally think the VIX is going to keep going down if this is right. So if this election is clear, if this COVID stuff is getting resolved, yes, we've had issues like the China trade war and everything else to give a spike to the VIX before, but we had low teen VIXs for years, and
yes, we did.
That tends to be kind of the natural course once we've resolved some of these big issues. So
right, if you think about it, it's interesting that the VIX, when the S&P 500 made its first all-time high of I think 35.88, and I'm probably or 33.98, I believe it was in February. The VIX had a 14 handle.
Yeah.
Here you are, basically 100 or so S&P handles higher ish, maybe even a little more than that, and you have a VIX with a 22 handle, and you had a VIX, by the way, with a 40 handle a week and a half or so ago, which is really interesting. So, I think you have to listen, as a trader, I know you can speak to this, but I think it's important for the participants and the viewers to understand, you have to be fluid in terms of your strategies and how you implement your strategies as the VIX moves. I mean, so much is contingent upon that. So, you can do things in a 24 vol world that might look a little scarier in a 40 vol world, and vice versa, quite frankly. But you have to be aware of where things are. And I think to a certain extent, and you just said this, you have to have a view as to where things are going in terms of the VIX. Is that accurate?
Yeah, I think so. I mean, just as a reminder for those that are not fully familiar with the VIX tends to rise when the market's falling, and the VIX tends to fall when the market's rising. So you touched on the fact that the market's higher and the VIX is higher. The fact that the VIX is higher is not necessarily surprising just because of where we were, 2-3 weeks ago, looking like we might have a market collapse at some points. We've had a lot of big movement over the last few days. So it's hard to just completely sell every option on the world. But as things settle down and we start lowering our daily ranges instead of getting, 2, 6, 8% moves in these indices.
Right.
I mean, I think small caps have moved at one point like 7 or 8% yesterday.
Unbelievable.
It's really hard to sell options on an 8% move in an index like that. But when you start seeing those moves, the ranges fade back down towards 0.5%, 1%, then people really get comfortable selling options, pushing the VIX lower. And that actually kind of leads towards, as you see it happening, it's almost, stair-stepping together. As the VIX falls, people get more and more comfortable just with a grind higher mentality. And it almost is sort of a self-fulfilling prophecy. The VIX falls, so the market goes up, so the VIX falls more and the market goes up more.
Yeah, it does you're right to your point about self-fulfilling. Absolutely. Yeah. And I apologize, folks. You see me leaning forward because I'm looking at questions, and I encourage everybody to, if you have questions, please type them in either the chat or the Q&A. That's why you see me continuing to lean forward. But one of the things we have to talk about has been the extraordinary move, and it is extraordinary, in interest rates.
Yeah.
You talk about yields going from, 10-year yields going from 53 basis points to 90, either side of 90 basis points in a very short period of time, which, you can do the math in terms of percentage move. That's a staggering move in something that really shouldn't move that way. So what are you looking at? Are you taking any cues from bond market, from rates going higher, bond market as measured by the TLT, let's say, going lower?
Yeah, so TLT is an interesting one to me. I mean, if I look back, let's say last summer, TLT is still significantly higher than where it was last summer. IWM, which we mentioned earlier, is slightly lower than where it was last summer. The Qs have obviously exploded. Like energies are about half the price of what they were last summer. But when I'm looking at and this is kind of a ridiculous thing for me to think about a 37 bip move in interest rates being a huge deal, given that in 2005. That's just almost a day, right? So, but that was at a much higher interest rate level. So now when we're thinking about it basically at zero, how do we get off that floor? Well, part of it is that getting that fundamental news. And I think the COVID thing might be what gets us to say that there was a floor now. And I don't know that we're ever going to see interest rates back below 50 bips on the 10-year.
Right.
It just, it seems irrational that we would without something new major happening, knock on wood, because frankly, every time I think that there's no more fundamental problem, a new one pops up. That's the nature of 2020, I guess, for everybody. As I watch bonds, as these yields rise, it makes me more and more to think about financials, though, because financials tend to perform better when they can capture a better yield spread, and they can do that better in a higher interest rate market. And 50 bips versus 90 bips may not be enough, but maybe once we're getting over 1%, up into 1.5%, there's some money to be made for the financial professionals.
Yeah, and I think you touched on something. It might not be enough, but it's certainly some of those headwinds are abated a bit, and they're not necessarily tailwinds at 90 basis points, but they're certainly not the wind in the face of the banks that we've seen over the last year or so. And you've seen the commensurate move. I mean, not to play individual stocks here, but you've seen a JP Morgan go from a $94 to 115. Even Citi, which was just a disaster, has gone from the low 40s to the high 40s. So you're starting to see these banks move. And if your view, folks, is that bonds are going to continue to get sold off, rates are going to continue to go higher, there might still be some room in a lot of these financial names that have been left for dead for so long. In terms of levels, I'll just throw one out there. The TLT bottomed around 154 or so, I believe, on June 8th. I'm doing this from memory. And if you look, that's basically right around where we're trading now. So either you've put in a significant bottom in terms of the TLT, in other words, rates have stopped going higher, or we're going to break through. I have a view. It doesn't matter what my view is, but you trade around levels. And I think in terms of the TLT, this 154 level is a great line in the sand and something that you should have up on your screen if you're making decisions based on bond moves.
No, absolutely. And I think the other thing that we also always have to remember, because this is kind of part of my trading thesis anyway, is that computers really dominate the world right now. So when we see a big level, like you just mentioned in TLT, if we start to get close to it, I know the computers are basically going to be pressing and trying to see what happens if we get below, because a lot of people will set a stop. So basically, in order to sell out of a long position or even enter a short position if we get below. That's an opportunity potentially to create a major move, rational or not. We're getting close to it. I think we're going to see some really big volume trading around that level. If we get below and stay below, then we start looking at the next levels, and maybe it's back even down into the 136 range, the lows of December of last year. I mean, that's a huge move in the interest rates, and that really could probably start that much more excitement towards the financials.
Right, and that probably correlates. I can't do the math in my head, but that probably correlates to a 10-year yield of about 120 or so in terms of the TLT level. And we've half answered a question I got from one of our participants. And the question is, what sectors are you bullish on for the rest of this year? Which, by the way, as everybody realizes, is coming to a very quick close. But I think we touched on the financials, and I'll answer this, and I'll let Keith sort of chime in as well. But I think the resource trade to me is still a go. That's something I think we touched on last time we did this. I know we talk about it on Fast Money a lot, but certain names have more than doubled in a very short period of time. And I think for most people, it'd be like, the move's over. I would submit, if the world is right in this resource trade, and if we do see some sort of fiscal stimulus, and if we do see the dollar continue to sell off, and if we do continue to see what people deem to be this global recovery that I'm somewhat skeptical about, by the way, I think the resource trade, the iron ore trade, the copper trades, the steel trades, gold, precious metals, I think they all still work, Keith.
Yeah, I mean, I would say a similar kind of concept, and I'm kind of focused on oil as a sector because that's one of the sectors I really watch. So for those that don't know, I used to work for a commodities-based hedge fund, and with oil being one of our big trading avenues there. So when I look at oil right now, oil seems to be just getting started. I think there's a chance that sub 40 just isn't going to happen again under this new regime. And if that's the case, I can look at XLE and talk about where that was a year ago. I mean, I can just give you a single name now just for, throwing it out there. Exxon Mobil. It's now a $36 stock.
Yes, it is.
Back in, let's go with January of 2019, this was a $75, $80 stock. I mean, Exxon Mobil's not going to fail. And maybe you have some energy names that just can't survive at $40, but ExxonMobil's not the name that's going to fail at $40. And if we get back towards 50, 55, I got to think stuff like that can really perform well.
Yeah. And it's interesting you mentioned Exxon, and we're going to jump to another question, but Exxon had so many things working against them. Obviously the oil collapse last year, the subsequent move towards ESG investing. And then obviously I think the final was them getting taken out of the Dow. But if you look, and you touched on this, you go back and look what the March low was in Exxon, and if memory serves, it was right around $31. And go back and look where we just bottomed out at recently. So for you technicians out there, in my opinion, you have a nice little double bottom. You have something to trade against. So I agree with you. So we have a question from, I think it's Burin, and I apologize if I'm pronouncing your name incorrectly. I'm just trying to see this. And the question is, and this is a great question, how can the VIX go down whilst the president does not want to acknowledge his loss? Again, we're not looking to get political here, but it's a fair question. This is a huge event that can turn that VIX around quickly. And again, I think Keith sort of spoke to this, but I'll chime in quickly and say, on Monday, you saw at one point on Monday, the Dow Jones Industrial Average was up over 1,500 points and the VIX was getting whacked. And then late in the day, you saw the Dow basically cut in half, and the VIX actually closed higher on the day. I think it closed around 29. Now, obviously, a lot's changed since then, and the VIX has sold off. But I'm in your camp. I still think over the next, whatever it is, 69 or 70 days until Inauguration Day, there's a lot that can still happen. So, I don't think the VIX is properly pricing in, to your question, some of the things that can still transpire. So I think that's fair. I don't know, by the way, I'm shocked that the VIX is here. If you had told me that a week and a half ago, I would have said no way. But that's, as they say, what makes markets. We have a question from Michael, Keith. What are the potential long-term impacts of a $7 trillion Federal Reserve balance sheet on the economy and major asset classes? Michael, I'm going to let Keith sort of chime in. I think that's a great question, by the way. But quickly, in my opinion, the long-term impacts are exactly what you're seeing. I think you're going to see continued weakness in the dollar. And I think, Michael, you're going to see continued strength in precious metals and the resource trade. Keith?
Yeah, I mean, I think that generally speaking, when I think about the $7 trillion Federal Reserve balance sheet, at the end of the day, it's hard to say that it's going to matter because it hasn't mattered from $1 trillion to $5 trillion all the way up to $7 trillion. The Fed does what they do in order to keep assets where they want them to be. If at some point that unwind occurs, that's where I start to get really nervous. So if interest rates get high enough that they start to feel some pain on it and we have a real problem, maybe we have an issue. But for now, for me, I kind of just try to say, all right, I can kind of ignore it and think about the tail risk scenario, but not about it as a day-to-day issue. Just got to have that tail risk scenario in the back of my mind of, can this create a major economic collapse? And if so, we're all going to be in a lot more hurt than I think anybody has talked about over COVID or anything else in terms of financial market impact. So
yeah, it's pretty incredible how quickly the balance sheet went from what seemed to be, $4 trillion seemed to be like there's no way. And then if you remember October, I think it was 2018, if memory serves, is when Jerome Powell stepped in. And if I'm trying to sort of paraphrase his language, but he basically said, listen, we're on a path to normalize rates and we're on cruise control. And oh, by the way, we're going to whittle down this balance sheet. And if you remember, the stock market in about a month and a half went down 19.9% in pretty much a straight line. And he completely backtracked on that. So my view on whether that was right or wrong doesn't matter. I happen to think, by the way, he was on the right path and he should have let the market do the hissy fit and continue on that path. I think we'd all be a lot better off now. Yeah. But in terms of a $7 trillion balance sheet, the Fed talks about there not being inflation. Well, if they measured inflation, there would be, number one. And, vis-a-vis a weaker dollar, whether they acknowledge it or want to say it or even realize it's happening, their actions make the dollar diminish in value. And a diminished value dollar is, by definition, both inflationary and takes away from your buying power, neither which are good. And those are some of the impacts that I think, if you're living in the world right now and you're living in the United States, you're absolutely feeling.
Yeah, I mean, just a quick note on that. You mentioned inflation. If there are inflationary measures, or like looking at oil prices and gold prices, they're not going to catch it. When they look at the stock market prices, you could easily see inflation there as a result of their actions. So it's just a matter of how they measure it. And, it doesn't matter if you use the incorrect method of measure, then of course you're not going to see inflation. So
now this is another question, and this is sort of outside of our purview, but I think it's worth bringing up only because, a lot of people have been talking about it recently, and it seems to be becoming more mainstream with some of the news from PayPal and some of the major banks. But Santiago asks, should we also go with crypto and Bitcoin in terms of, an asset class or in terms of investment? Now, I know it's probably not something you watch very closely, but maybe you do have some thoughts on crypto here, Keith.
So I had started doing a lot of research on crypto, about a year ago when it was getting a little hotter. I've kind of pulled back on that, dialed back a little bit. And part of the reason is because I think that for crypto to really get hot, we're going to see it in precious metals first. I do like crypto as a long-term play. I think it makes sense. The question is it the investment or the trade today? For me, the answer is no. If gold, silver, platinum, when we start to see that quote unquote inflation trade we were just talking about coming through in precious metals, when they start to move, then I think that crypto can really get a little bit more exciting. But until we see some of the more like commonplace inflation trades, I think crypto is going to still kind of have a little bit of a backseat in this market.
So Cameron, I appreciate you being here. I think you're calling in from the UK, so thanks for staying up. Here's this question. On Monday, we saw some cyclicals fly up. For example, here in the UK, we saw Rolls-Royce move nearly 95% intraday, which I didn't know. That's amazing. Do you think some of these moves are pure speculation, or maybe a good time to move into some of these while they're still lower than last year? Good question. I can't speak to Rolls-Royce, Cameron, but what I will tell you is, the cyclical trade here, for example, just to play stock market a little bit, Caterpillar was dead in the water seemingly for years. Caterpillar couldn't get out of its own way. And you go back and look 2.5, 3 months ago, there was a $132 stock languishing. And now it just, I think, was trading north of 170 last I looked. And quite frankly, valuation wise, it's still not all that expensive. So I do think, if we look, it seems as though we know what the administration's going to look like, and we know what the composition of the Senate's going to be by and large. And maybe, again, if Joe Biden is duly sworn in as president, maybe he'll be able to reach across the aisle, get a fiscal stimulus deal done. And I think there's going to be a lot more room in those deep cyclicals like a Caterpillar, for example. I think that's a great question. So to answer your question, yes, they've moved a lot, but it doesn't necessarily mean the move is over.
Yeah, I think one of the things that I always try to think of like a good analogy for what people are doing here. And I almost feel like somebody basically came in on Monday morning and said, I got to remodel my house. And they came in with a sledgehammer. So they just hit everything they could. They moved everything around as fast as possible. Things just got kind of way out of whack just on a short-term move. It doesn't mean that the move is over, but for the next couple of days, somebody that bought Rolls-Royce up 95% on Monday is going to feel a little bit of pain. And if he's a trader, he's going to get out. An investor is going to say, okay, up 95% in one day doesn't matter to me, because when I look out 4 years, I'm going to make money on this trade. So, or investment. So it's a trade versus investment philosophy. I think that's kind of what we got, a little bit of over exuberance on the trade because of the investment reallocation on Monday and Tuesday.
And I think some of your strategies at Option Hotline speaks to exactly that.
Exactly.
And I encourage you, I encourage folks to take a look at that for sure. And we'll let Keith speak to that. But quickly, I want to answer what appears to be our last question. I hear a lot about stock buybacks. Can we get an opinion on that strategy? So quickly, what I'll say, and I'm not suggesting I'm right, but this is my opinion since you asked for it. I think one of the many unintended consequences of a very liberal and accommodative Federal Reserve is that they've made corporate America lazy. And, people no longer really had to focus on their business, on their company. They just borrow money cheap, buy back their stock, pay a dividend, stocks go higher, and everybody was happy. But, IBM is sort of the poster child for that strategy. And I think it sort of left them in the really bad place. Whereas a Microsoft actually focused on their business 5 or 6 years ago, I think IBM just got lazy. So to answer your question, I'm not condemning stock buybacks, but I think for most of corporate America, it was just a lazy way to take advantage of a very accommodative Federal Reserve. Keith?
Yeah, I'd say a similar opinion. I mean, generally speaking, when I see a company buying back their own stock, they're telling you that they don't see a better investment than an investment in themselves or in what they've already done. So they're basically saying, yeah, we can't do any better out there in the market. I can't borrow money and acquire a new company. You know, if you've got accommodative Fed and you've got free money, if you're literally telling me that you don't see something out there that can be accredited to your business by an acquisition, then I don't think you're doing your full due diligence.
Right.
If all those other asset values are way too high, then why are you buying back your own? Because your asset value is probably too high too. So if you don't see a way to grow, then why are you taking away everybody else's money and doing it dividends? I don't know. It doesn't make sense to me. I'd rather almost have those companies just say, I'm going to build up my cash portfolio and wait for an opportunity, because they happen. You know, what we see in these market dips is sometimes a company goes out and they get to buy a stock or buy a company at a cheap valuation because you had 3 months of, turmoil, and a company says, I'm going to panic and just sell over to Apple, and Apple can do better as a result. So,
and if the final couple minutes we have left, because unfortunately I have to sort of skate to do something.
You got something else somewhere else to be.
Maybe Keith, maybe you could speak about, some of the things you have going on Options Hotline. Some of the things that the folks that have been here with us last half hour can take advantage of. Yeah.
So, I mean, I think we've done a lot of talking about basically investing versus trading. And I think that there are opportunities in both situations right now. We have programs that are built upon short-term trades. I think those are going to start to become more evident as the VIX drops and as short-term moves become that much more, basically week or 2 week long moves as opposed to day-to-day movement. The investment thesis has been a really good sector for us this year. I mean, our trend trading program, Option Trend Trader, as of Friday's close, was up 151% on the year. Just basically taking these names that the market identifies for us as the winners of everything else going on in the fundamental world. They basically set the trend, and then we just jump on. I mean, that's the goal, is to find the direction of the current and just ride the current and not get stuck in these names that aren't going anywhere. Using risk management protocols and everything else, you can turn a good return just capturing the trend and using the leverage of options. And that's been our big goal, trying to find those ways to do that. So, as you mentioned, I think right now is a good time to start looking for that market rotation. That's going to set new trends. That's going to set new leverage. That's going to create opportunity. And I'm excited about how that can go forward.
And I'll jump in here briefly, fellas. I know Guy has to get ready to go shortly, but I do want to make sure and mention to everyone to stick around. Keith just mentioned Option Trend Trader and how he's trading the markets today. We're going to display a coupon code and walk you through how to use that for a huge discount. Mm-hmm. So I just want to make sure. I know Guy had to go, and we're really grateful that he was able to give us his time this afternoon, but he's off on CNBC Fast Money getting ready for that. So hopefully after you're done with our webinar in a little bit, you can go tune in and watch Guy carry on his conversation. So Keith, I'm going to go ahead and I think share the screen real briefly, just so I can show everybody. There it is. All right. You should be seeing a coupon code right here. So Keith, you mentioned Option Trend Trader. We're talking about riding the trend, riding the current, figuring out what the market's doing and not necessarily trying to fight it, but trying to make it work to your advantage.
Yeah.
And this is exactly what you do in this program, right?
Exactly. So, I mean, you may have days like we've had on Monday where, Zoom gets crushed. That wasn't part of our portfolio. That's good. But, you see these names that have these long lasting trends, and you can ride them for months. And the way that we apply the strategy is always trying to build up cash back in the portfolio. So if you catch a name that's going to trend for 3, 6, 9 months, maybe even years, there's really good leverage that the options market provides. I mentioned earlier that stock replacement strategies are really interesting to me right now. That's really what Option Trend Trader focuses on, is stock replacement strategy. So I think this is actually a really nice time to be looking for new trends and taking advantage of what the market's going to offer for us.
Definitely. And I just want to point out, you can all see this. The coupon code is Amazing Year. I'm circling it here. It's one word. And actually, I'm going to go ahead and walk you all through how to get to the website, look at Keith's products, and type in this coupon code to get $1,000 off an annual subscription. That's huge.
Yeah.
That's incredibly amazing. So thank you, Keith, for doing that for our attendees. I'm going to go ahead and do that now. And right now, well, here's back to the webinar page. As those of you who are on the beginning website tour, you've seen this already, but for those of you who have missed it, please hang tight. We'll be on just a few more minutes. You want to be sure to go to the webinar page to find out about our upcoming webinar. And Keith, why don't you actually let people know when your next webinar is while I'm letting them know how to get to your product page and use that coupon.
Yeah, absolutely. So we're doing another webinar next week. So tune in if you've got the free time today. Hopefully you have it again a week from today. Just going to talk more about Vega, the VIX, basically talking about more of that options analysis and how it can make or lose you money when you don't understand the risks involved. It'll actually also, I think, help explain why those stock replacement trades are a little bit better now, and other types of strategies might be better off in the coming months, especially if the VIX does start to fall below 20. So I think that'll help a lot of people just get a better understanding of how I use options and how it might help them too.
Wonderful, thank you. And as you can all see, I am now in the shopping cart. I have added Option Trend Trader and annual subscription to my cart. Over here is where you type in the coupon code. So I clicked in the gray box, typed in amazing year, and I'm applying the coupon. While I'm doing that, you can see $1,000 was just removed, and you would be able to proceed to check out from there and enter your information accordingly. I do also want to point out an extra, I consider this to be an extra bonus offering for everyone on today's webinar. We have a rep here from Market Education, and he is basically what we call an enrollment coach for Keith's products. If you're someone who wants a little extra help, just wants to talk in much more detail than we have time on the 30-minute webinar to go into about Keith's products, his entire catalog, about trading, about what would work for you, get additional special offers. I want you to talk with our enrollment coach. Stephen, are you there?
I am. Hi, Natalie. Hi, Keith.
Hi, Stephen.
Hi, welcome. Thank you for popping on. If you want to just let everyone know how your services can come about, how they can get in touch with you on today's webinar, that would be amazing.
Sure. The first thing anybody can do, if you have any questions about Keith, about his trading services, about his return, his risks, costs, etc., please type your name in the chat box, and I'll contact you directly after this webinar, or put a time and a date that you'd like me to call, and I'll call you at that time. But we work with people directly and help explain how these services work. And a lot of people don't know that you can get email and text alerts directly from Keith for his options trend trader and for other services that he offers that we service. And that's pretty phenomenal to be able to not just listen to webinars and read Keith's materials, but to be able to know exactly when he's buying something or when he's selling something. You get direct buy to open email and text alerts to enter a position, and STC, or sell to close, email and text alerts to exit those positions. So again, if you put your name in the chat box, I'd love to give you a call personally. I'll get your information, or anyone can call me directly anytime at 312-858-9009.
Thank you so much, Stephen. Yes, and I'm circling your phone number and email as well right here on the site. So if you do want some one-on-one discussion, more details about Keith and his products, please reach out to Stephen and his team at 312-858-9009. Alternatively, go ahead and type your name and your contact number in the chat box right now, and Stephen will be sure to reach out to you for that. One other last thing before we get going, I just want to remind everyone to keep a lookout for our emails, because you are going to be getting the replay, as well as emailing out that coupon code that I showed you before. I'll show you one more time before we say goodbye. So make sure that you're whitelisting our emails so that we hit your inbox and not your spam traps. And be sure to watch for webinars at optionhotline.com. I'll show that coupon code one more time. It's a lovely little parting gift. Again, for Options Trend Trader, for being an attendee on today's webinar, type in amazing year at the checkout and get $1,000 off on an annual subscription. So please be sure to take advantage of that. Keith, thank you so much for taking the time. I know Guy had to go already, so we thank him as well. Thank you to Market Education for popping on and offering your additional services. We do appreciate it. And remember, everyone, to go ahead to the Option Hotline website and sign up for Keith's webinar next week, where it's going to be talking about part 2 of trading with a directional bias, if memory serves, right, Keith?
Yes, absolutely. Absolutely. So thanks again for everybody coming on. Thanks to Guy. I know he'll probably watch the replay, so my thank you will be tomorrow. But thanks again to all for all the great questions, and we'll look forward to doing it again.
Sounds great, everyone. Thanks so much, and have a good rest of your night, and a happy Veterans Day to all those who serve, have served, or family members of our loved ones who are in active service. We appreciate you. Have a good night.